Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapliyal and today we have a very exciting show for you today because we are going to prepare you for 2025. Yes. What are going to be the areas where you should be looking at or maybe revamping or reshuffling your portfolio, keeping in mind the triggers for 2025. We'll be recording all of that today with Nilesh Shah, and we will also focus your strategies in the small cap category, and we will also throw on the counter to get your mutual fund portfolio queries answered. Just in case you want to ask us any question, you can WhatsApp your queries on 8657974571. You can also email us your questions on the Money Show at etnow.tv. All right, so let's begin. And Kotak AMC released its market outlook report for 2025. The report highlights various themes investors should keep an eye out for in the coming year. By when can one expect the current volatility to subside, and how will India's growth story shape up, and should one taper their return expectations going forward? We discussed all of this and more with Nilesh Shah, MD, Kotak AMC. So let's listen in. So it's that time of the year where we talk about market outlooks, and talking about market outlook 2025 of Kotak AMC, I am joined by Nilesh Shah. Hi and welcome to this very special edition. And you have released your report where you have sort of analyzed the market outlook for the next calendar year. For the investors, the very first question, should we tapering our return expectations? Should we be moderating our return expectations as per the outlook? What do you have to say?
Undoubtedly, yes. Last 5 years have seen exceptional return in large cap, small cap, mid cap and overall market. We think over next 5 years, those returns will moderate significantly.
Okay.
And this is also proven by back of the envelope calculation. When your inflation is little bit on the higher side, your nominal return goes up. We expect inflation to come down over next 5 years compared to last 5 years, and hence nominal return also has to come down.
So, but then talking about the market trajectory, and obviously we can't predict how the market will be in the entire year, but then having said that, what are the important triggers that your reading can play out in the most maximum way in the next year?
So in very crude sense, if money is going out of the market, markets will fall.
Right.
If money is coming in the market, markets will rise.
Right.
Now, clearly domestic investors are going to keep on investing. Between our SIP flows, pension flows and insurance flows, domestic investors remain well bidded.
Right.
On the other hand, supply will come only at appropriate level. No one is going to invest, no one is going to raise money at lower prices because they have seen higher prices.
Right.
So the variable for us is foreign flows.
Okay.
If they continue to sell aggressively, no one is going to give them an easy exit. But the day they come to buy, that could pull the prices higher.
All right. Talking about government spending, talking about the corporate capex, and also looking at the quarterly numbers that we are seeing, how likely is the trajectory positive for India, or how strong are we here in terms of overall spendings and capex? How do you sort of analyze this for the next year?
So there were some amount of subduedness in August and September. The diesel sales, the cement sales, the auto sales were all subdued.
Right.
And GST collection has been growing below nominal GDP growth rate since May 24.
Right.
And all this came to reflect in the second quarter GDP number at 5.4%, well below expectations.
Right.
Now, if you are charitable to the government, you can say that it is partly driven by rains, which were widespread this time, disrupting traffic. Second, Shraddh period in September, where people don't purchase big items. And third, the low capex of the government, because April to July, we were in election mode.
Exactly.
Now, in October, things have revived undoubtedly. Two-wheeler sales have been growing. Post-festival season better than pre-festival season. Cement sales are up, diesel sales have turned positive. But the GST collection still remain below nominal GDP growth.
True.
My feeling is that government will step up the capex.
Okay.
It's a tall task. They have to increase capex by 68% every month in second half compared to first half. The capex has to move from 69,000 crore a month to 1,16,000 crore a month to achieve budgeted capex target of 11,000 crore.
Right.
So my feeling is that the second half will be certainly better than first half.
Okay.
Because of festival season, government capex and the wedding season. But will we be able to go to the RBI's target range of 7% plus GDP growth? That looks difficult.
Talking about specific sectors, what sectors are going to play a major role, or maybe have started reflecting that particular trajectory that we might see in 2025?
So I think now it's a bottom-up story rather than top-down story. You'll have to really pick up companies which are taking advantage of the opportunities in front of them. But broadly, within the sectoral allocation, we think go for quality over momentum.
Okay.
Go for reasonable valuation over expensive valuation. And go for high diversified ownership rather than concentrated ownership.
Okay.
Subject to that, we believe IT, pharma, to some extent consumer staples and telecom should be market outperformer.
Okay.
On the other hand, some of the capital goods infrastructure companies, despite government pickup, may not be able to deliver as per expectations.
As far as your fund house strategy is concerned, is a strategy likely to be on the same lines, the sectors that you've mentioned, the kind of companies that you're looking at, and the growth strategy, value strategy, all of this thing is always in trend, and investors want to understand how can a fund house break this down to them. Are we looking at a growth strategy portfolio from your end?
So we are always growth at reasonable prices. Okay. But earlier we were betting on a betting pitch and within the filters within the small narrow circle. Now betting pitch is becoming even pitch where bowlers also have a good chance and field is widespread.
Right.
So we won't be able to score 4s and 6. We'll have to keep the scoreboard running by taking 1s and 2s. And which is why the most important message to investor is please moderate return expectations.
All right. 3 risk factors, if you have to count and explain our viewers, in 2025, these areas or these kind of strategies can prove risky. So just stay away.
The 3 risk factors for us are self-goal, self-goal, self-goal. Of course, if US interest rate goes up or oil prices goes up or President Trump puts tariff, that will create disturbance. But for us, the bigger worry is ability to score self-goal. An investor can make a self-goal by having higher expectations and then getting disappointed and taking action which is not appropriate. So please control your fear and greed. As a fund manager, I can make a self-goal by ignoring valuation and trying to play the same game which I was playing in last 5 years, where making money was relatively much easier. Next 5 years, I'll have to generate return by sector rotation and stock picks. It's going to be a tougher market to make money. And as a country, we can make self-goal when we don't take advantage of the opportunities and perform below potential. Today, there is China plus one available to us. Today, there are many other opportunities to leverage infrastructure which we have already built. A case in point is that our highways are almost 38% of China's highway. But our GDP is just about 19% of China's GDP. Which means I haven't leveraged my highways despite being built.
Right. All right. So, point to note down for all the investors and viewers, beware of doing a self-goal. Thank you so much for talking to us, and that's a wrap. Thank you so much for watching.
If you like this video, then like, share and subscribe to ET Now.